For your money. Joining me now is David Zervos. He's the chief market strategist at Jefferies, and CNBC's Rick Santelli is here as well. All right, gentlemen, I'm struck, Dave, by the reaction here where bond yields are still near their highs, but stocks are now near session highs as well.
Seems to be a pattern, Kelly. I mean, the market, the risk asset market in general, credit and equities are just trading really, really well, even in the face of these higher bond yields. And maybe keying more off the economy itself and the data that we're getting and the fact that this is a strong economy, as Jay Powell put it. And maybe policy really isn't as restrictive as many people thought it was for a variety of reasons that you've been discussing with your past two guests, as well as those that Jay discussed in his presentation at the New York Economics Club.
And Dave, you were one of the first people pounding the table on corporate credit, which is starting to become something we're hearing more and more about. Just very tactfully, very specifically speaking, what is it that you think people and investors should be doing right now as they navigate this new environment?
Well, look, we've all year highlighted the fact that the debt markets had repriced significantly last year, particularly in high yield credit, and you were paid quite substantially to take credit risk over equity risk this year on a risk-adjusted basis. Still think that's the case. You could get sub-investment grade single B and double B yields in the double digits, something we haven't had for a long time, in an economy that was reasonably robust. And a lot of people really pushed back on us, Kelly, at the beginning of the year because pretty much everybody was calling for a recession. And they said, how can you be in yield credit during a recession? Well, we weren't really talking about a recession. We were talking about policy that actually wasn't that restrictive. And again, Kelly, you know, my views are not necessarily aligned with the discussion you just had. I don't think it's a lot about fiscal. I think this is much more about the outsized balance sheet at the Fed and the residual QE.
And that's absorbing a lot of the blows to the economy. One more, because I want to bring Rick in, but it's on the next question I'm going to ask, which is, aren't we restrictive now? Look at what real rates are doing. I mean, I didn't check. I think we had a tips auction this hour, too. But, like, we just keep shooting higher. Dave, at this point, we've got to be restrictive, no?
Well, I think we have restrictive rate policy. The question is, do we have a restrictive balance sheet? The balance sheet is still $8 trillion. It's still absorbed $2 trillion worth of losses in the last year and a half as the portfolio lost money. All of those are huge stimuli that still exist in the economy and are way above what I would call a neutral balance sheet. It's fascinating to me, Kelly, that nobody asks anybody at the Fed what they think a neutral balance sheet is.
True.
They won't talk about it. And they don't know because, as Ben Bernanke said it, you know, QE works in practice, not in theory. They don't have a theory. But that doesn't mean it isn't substantially stimulative. And I think that's the big miss across the board. All this fiscal stuff, to me, is a sideshow.
All right. Rick, I'm looking at the 10-year tips yield. We're at about 248.
Yeah, you know what? Listen, tips are a lot, in my mind, like 20-year, like the 7-year was. Listen, we could look at tips and we could look at the break-evens. I'm not sure I put the full faith and credit of my brain assessing that those are really reflective where I see inflation rates. But what I do see is the constant debate that Steve just pointed out that everybody's been discussing and pointing fingers at anybody who's talked about a recession is wrong. Well, I don't necessarily believe that entirely. Anybody who read the Beige Book yesterday, did anything that they state sound like a 3.5% to 5% GDP economy to you? I think the issue is simple. And I'll tell you what, Mr. Kaplan, I think you win the trophy of the month, because I think just about everything you said makes sense from the bond vigilante perspective. Fiscal stimulus was bigger, it's lasting longer, and paying people certain areas that continued post-COVID not to necessarily work immediately. All of that is much slower in unraveling than many thought. But there's no doubt that it exists. And when we say, are rates now restrictive enough? You know, here's what I could say. Why did stocks do better? Because two-year notes went nowhere. As a matter of fact, right now, look at an intraday and then quickly look at a two-day. We're dabbling under yesterday's low yields. But it's the exact opposite of what's going on in a 10-year. Now, that's simple, and it's been discussed already, but that's really important because they're not restrictive enough. And the Fed, our chairman said, and I'm almost quoting, and basically what he said is that interest rates are found through supply and demand. well, that's what the market's trying to bring out. That's what the market's trying to finally do.